China, the most important country in the notion of development, has progressively raised its economy through years of consistency. Is there any specific trial? Well, there is. Let's peek back into the journey of 4 decades of the economy of China from minimal to the second rank in the world's economy. The economic history of China. Before 1979, China, under the initiative of Chairman Mao Zedong, kept up a midway-ranged economy. A huge portion of the nation's financial yield was coordinated and constrained by the state, which set creation objectives, controlled costs, and distributed assets all through the vast majority of the economy. During the 1950s, the entirety of China's individual family unit ranches was collectivized into huge cooperatives. To help quick industrialization, the central government embraced huge scope interests in physical and human capital during the 1960s and 1970s. Thus, by 1978 about 3/4 of modern creation was delivered by midway-controlled, state-claimed ventures. Private ventures and remote-contributed firms were commonly banned. A central goal of the Chinese government was to make China's economy self-sufficient. Foreign exchange was commonly restricted to acquiring those products that couldn't be made in China. Such arrangements made distortions in the economy. Since most aspects of the economy were managed and run by the central government, there were no market mechanisms to efficiently allocate resources, and thus there were few incentives for firms, workers, and farmers to become more productive or be concerned with the quality of what they produced. According to Chinese government statistics, China's real GDP grew at an average annual rate of 6.7% from 1953 to 1978. Introduction of economic reforms. China's economic reform appeared in 1979. By then several reforms had already been launched. The central government started price and ownership motivating forces for farmers, which empowered them to sell a bit of their harvests on the free market. In addition, the government established 4 special economic zones along the coast for the purpose of attracting foreign investment, boosting exports, and importing highly innovative products into China. What's more, residents were urged to begin their own organizations. Extra seaside areas and urban communities were assigned as open urban communities and advancement zones, which permitted them to try different things with free advertised changes and to offer duty and exchange motivating forces to pull in foreign investment. Since the introduction of economic reforms, China's economy has grown substantially faster than during the pre-reform period. China's annual real GDP averaged 9.5%. The global recession, which began in 2008, had a significant impact on the Chinese economy. China's media reported that 20 million migrant workers had returned home after losing their jobs because of the financial crisis. The Chinese government responded by implementing a $586 billion economic stimulus package, aimed largely at funding infrastructure and loosening monetary policies to increase bank lending. Such policies enabled China to counter the effects of the sharp global fall in demand for Chinese products. As a result, the rate of GDP growth decline slowed for the next 10 consecutive years, falling from 10.6% to 6.0%. So what caused China's economic growth? Economists generally attribute much of China's rapid economic growth in 2 main factors. One is large-scale capital investment financed by large domestic savings and foreign investment, and rapid productivity growth. These 2 factors appear to have gone together hand in hand. Economic reforms led to higher efficiency in the economy, which boosted output and increased resources for additional investment in the economy. China has historically maintained a high rate of savings. Economic reforms, which included the decentralization of economic production, led to substantial growth in Chinese household savings as well as corporate savings. As a result, China's gross savings as a percentage of GDP is the highest among major economies. The large level of domestic savings has enabled China to support a high level of investment. A few business analysts have concluded that productivity gains have been another central point in China's fast economic development. The upgrades to productivity were caused generally by a reallocation of assets to more productive areas, such as agriculture, trade, and services. However, as China's technological development combines with major developed nations, its productivity gains and GDP growth could slow altogether from its historic levels except if China turns into a significant community for new innovation and development or gain new complete economic reforms. In any case, sooner or later in their development, some of these nations started to encounter economic inactiveness over a continued time, a wonder portrayed by economists as the middle income trap. This implies a few developing economies had the option to change to a middle-income economy, but since they couldn't support significant levels of productivity gains, they couldn't progress to a high-income economy. According to the World Bank, China went from a low-income economy to a low-middle-income economy in 1997, and in 2010, it became an upper-middle-income country. The Chinese government projects that China can cross the high-income limit by 2025. The Chinese government wants to move away from its present economic model of fast development at any cost to progressively smart economic growth, which looks to lessen dependence on energy-intensive and high-polluting industries and depend more on high innovation, green energy, and services. China is the world's largest manufacturer. China has emerged as the world's largest manufacturer according to the World Bank. In 2016, the value of China's manufacturing on a gross value-added basis was 49.2% higher than the US level. Manufacturing plays a considerably more important role in the Chinese economy than it does for other countries. In its 2016 Global Manufacturing Competitiveness Index ranked China as the world's most competitive manufacturer out of 40 countries. On the other side of the coin, while China was expected to remain a major manufacturing power because of its large research and development spending levels, it was seen as confronting a few challenges, including a slowing economy, a decline in value-added manufacturing and overcapacity in several industries, rising labor costs, and a rapidly aging population. As a result, China was projected to fall to the second most competitive manufacturer by 2020. Foreign direct investment in China. China's trade and investment reforms and incentives led to a surge in foreign direct investment in the early 1990s. Such flows have been a major source of China's productivity gains and rapid economic and trade growth. There were reportedly 450,000 foreign invested enterprises registered in China in 2010, employing 55.2 million workers of the urban workforce. Foreign invested enterprises are responsible for a significant level of China's foreign trade. The United Nations Conference on Trade and Development reports that China has become both a major recipient of global FDI as well as a major provider of FDI outflows. A key aspect of China's economic modernization and growth strategy during the 1980s and 1990s was to attract FDI into China to help boost the development of domestic firms. Investment by Chinese firms abroad was sharply restricted. However, in 2000, China's leaders initiated a New Go Global strategy, which sought to encourage Chinese firms to invest overseas. In 2007, the Chinese government officially launched the China Investment Corporation in an effort to seek more profitable returns on its foreign exchange reserves and diversify away from its US dollar holdings. Another factor behind the government's drive to encourage more outward FDI flows has been to obtain natural resources, such as oil and minerals, deemed by the government as necessary to sustain China's rapid economic growth. Finally, the Chinese government has indicated its goal of developing globally competitive Chinese firms with their own brands. Investing in foreign firms is viewed as a method for Chinese firms to obtain technology, management skills, and often, internationally recognized brands, needed to help Chinese firms become more globally competitive. China's merchandise trade patterns, major trading partners and trade commodities. Economic reforms in trade and investment liberalization have helped transform China into a major trading power. Chinese merchandise exports rose from $14 billion in 1979 to $2.5 trillion in 2018, while merchandise imports grew from $18 billion to $2.1 trillion. China's rapidly growing trade flows have made it an increasingly important trading partner for many countries. In 2017, China's exports and imports rose by 6.7% and 17.4%, respectively. China's major trading partners include the 28 countries that make up the European Union, the United States, the 10 nations that constitute the Association of Southeast Asian Nations, Japan, South Korea, Hong Kong, and Taiwan. China's top 3 export markets were the United States, the European countries, Southeast Asian nations, while its top sources for imports were the European countries, Southeast Asian nations, and South Korea. China's abundance of low-cost labor has made it internationally competitive in many low-cost, labor-intensive manufactures. As a result, manufactured products constitute a significant share of China's trade. A substantial amount of China's imports is comprised of parts and components that are assembled into finished products, such as consumer electronic products and computers, and then exported. Often, The value added to such products in China by Chinese workers is relatively small compared to the total value of the product when it is shipped abroad. Major imports included electrical machinery and equipment, mineral fuels, nuclear reactors, boilers, and machinery, ores, optical, photographic, and medical instruments. China's biggest exports were electrical machinery and equipment, nuclear reactors, boilers, and machinery, furniture, plastics, and vehicles. Major long-term challenges facing the Chinese economy. China is currently undergoing a major restructuring of its economic model. Policies that were employed in the past to essentially produce rapid economic growth at any cost were very successful. However, such policies have entailed a number of costs, and therefore the old growth model is viewed by many economists as no longer sustainable. China has sought to develop a new growth model that promotes more sustainable economic growth that puts greater emphasis on private consumption and innovation as the new drivers of the Chinese economy. Implementing a new growth model that sustains healthy economic growth could prove challenging unless China is able to effectively implement new economic reforms. Many analysts warn that without such reforms, China could face a period of stagnant economic growth and living standards, a condition referred to by economists as the middle income trap. Stay tuned for part 2 and don't forget to hit subscribe button. We'll be back with more amazing info sharing videos.